Welcome to today's Explainer. We're diving into a massive and frankly kind of shocking financial anomaly that just rattled the tech sector. We are asking the big question today. Is the AI memory boom actually breaking? Let's get right into it.
Negative 9%. Look, if you've been following the markets at all, you know artificial intelligence has basically been this untouchable golden goose, right? But something just cracked. In the world of megacap tech, a sudden plunge like this isn't just a bad day at the office. It's a massive shock to the system. For an investor, seeing a huge player in the AI hardware space drop this violently, yeah, that's enough to induce some serious panic. But here's the thing, the shock value of this plunge is really only half the story.
Now, what's really interesting about this slide is the scoreboard. It's not just that SanDisk fell, it's how it fell compared to its peers. The contrast here is just stark. You've got NVIDIA, literally the poster child of the entire AI revolution, and it dipped a mere 2.3%. A minor bump. Then Micron drops 7%. And then there's SanDisk, taking a brutal 9% hit. That is nearly 4 times the decline of NVIDIA. Think about it. If the whole AI narrative was just crumbling, the entire sector would be plummeting equally. But they aren't. Which brings us to the fundamental question we've got to answer in this explainer. Why is Wall Street suddenly treating memory so differently from GPUs? Put yourself in the shoes of a portfolio manager for a second. You're staring at your screens trying to make sense of this market. Is there some hidden flaw in the memory business we don't know about? Are the big whales just taking their profits and running? Or is something much bigger happening underneath the surface of the entire AI infrastructure trade? Well, to solve this mystery, we really need to pull back our focus. To figure this out, we have to look at the broader AI ecosystem. We're talking about the complete technology chain required for artificial intelligence, which extends way, way beyond just single components. Because let's be real, AI isn't just some magic chip floating in the void, it's an entire interconnected neighborhood of technologies. When we talk about the AI economy, we're talking about massive data centers, and those require a complete symphony of different hardware pieces working perfectly in tandem. This technology chain includes vital organs like your GPUs, high-performance memory, storage, networking, and, of course, the massive data centers themselves. Now, SanDisk sits squarely in the memory and storage links of this chain. Logically, this sounds incredibly bullish. If AI demand is basically insatiable right now, the demand for storing all that data should be too, right? So here is the giant contradiction. If demand for this infrastructure is so incredibly powerful, why on earth is a vital company like SanDisk dropping 9%? To understand that contradiction, we have to shift our brains from silicon to psychology. There's this brilliant market adage that hits the nail right on the head. Investors don't buy a company's past, they buy expectations for its future. This perfectly illustrates the core mechanic of the stock market as this giant, forward-looking pricey machine. It's not like SanDisk's technology just stopped working overnight. No. It simply became less spectacular than what investors had already priced into the stock. The absolutely crucial point here is separating physical reality from the stock ticker. Because on one side, AI fundamentals are incredibly strong. We're seeing continued adoption, expanding data centers, and super robust real-world demand for these chips and storage. But flip over to the other side, and AI stock valuations have been priced for extraordinary, explosive, uninterrupted growth for literally years to come. And guys, a booming industry doesn't guarantee its stocks are going to go up forever. When expectations are set for absolute perfection, even the tiniest little shift in sentiment can completely shatter valuations. But what actually triggers that shift? What external forces could possibly make investors so selective so suddenly? Like, why decide today is the day to just dump memory stocks while holding on to your GPUs? To answer this, we've got to zoom out even further. We need to leave the semiconductor industry entirely for a minute and look at the broader global economic weather system. Okay, let's dive into this because the answer actually lies in the bond market, which acts like this mathematical gravity pulling on tech stocks. When Treasury yields rise, investors can suddenly earn a safer, higher return just from holding government bonds. Because of this, discount rates rise, which basically reduces the present value of a company's future earnings. The end result? Growth stock valuations fall. Semiconductor companies are priced almost entirely on those massive future earnings, so when the bond market moves, the math changes, and those high-flying growth stocks take the absolute hardest hit. And this creates this fascinating macro domino effect, where a global commodity actually triggers a localized tech sell-off. Watch how this works. It starts with higher oil prices, which naturally spike inflation concerns. The market then starts to panic, fearing that central banks aren't going to cut interest rates anytime soon, causing those Treasury yields we just talked about to shoot up. That mathematical gravity kicks in, and boom, expensive semiconductor stocks drop. Suddenly, SanDisk falling 9% looks a lot less like some random tech glitch and way more like a predictable mathematical reaction to a barrel of oil. Crazy, right?
So, where do we go from here? Well, we're basically looking at 3 distinct paths. First, the bull case. This view sees the 9% drop as just a healthy, temporary reset. AI demand is fully intact, and hey, this is just a great buying opportunity. Then you have the base case. This assumes demand survives, but the market is getting much tougher and way more selective, meaning you can't just slap the letters AI on an earnings report anymore. Actual cash flow matters now. And finally, the bear case, the absolute danger zone. If AI spending slows down while memory supply floods the market and yields stay high, yeah, that is a recipe for massive downside.
And you know what? The market might already be whispering which of those paths we're on. Just look at the pattern in how these losses are building up. You've got NVIDIA down 2.3%, Broadcom down 3.2%, AMD down 4.3%, the broader sector down 5%, Micron down 7%, and finally, at the bottom, SanDisk down 9%. The further you move out into those volatile, hardware-heavy names, the deeper the cuts become. So the real headline today isn't just that SanDisk crashed, it's that investors are systematically, methodically becoming very cautious about AI valuations across the board. Which leaves Wall Street staring at the ultimate open loop. Is AI demand actually weakening, or are these stock valuations simply becoming more realistic? Let's be clear about what this means for you. If demand is actually weakening, we have a massive structural problem across the entire tech sector. But if demand is totally fine and valuations are just undergoing this really painful reset to match reality, well then the long-term technological revolution is still incredibly healthy. So, is the AI memory boom breaking? Look, one bad trading session isn't enough to call the time of death on the entire AI rally. But a divergence this sharp? That is a massive, blinking warning light on the dashboard. Is this a brutal but standard market correction? Or are we witnessing a systemic repricing of the entire AI infrastructure trade? The dominoes are already in motion, folks. So don't just watch SanDisk. You need to watch the entire chain. Watch what happens next.